It's long-term what?
Okay, let's get started. Do you remember Spock and Kirk from Star Trek? Two innovative leaders who are better together than they are alone.
Spawn.
Welcome aboard, Captain.
Today, I'm reviewing Nationwide's CareMatters Together, a joint, hybrid, long-term care insurance policy. It's bold, innovative, and built around the idea that sometimes two is better than one, sort of like Kirk and Spock. This policy has two siblings that I describe in other videos, CareMatters, the individual policy, and CareMatters Annuity. Before we dive in, this was recorded in 2026. Policies get updates every few years, so be sure to check the link in the description for any changes. You'll also find star ratings for how CareMatters Together stacks up against other top policies. First, let's quickly talk about some standard benefits that come with most modern hybrid policies. Your benefits kick in when you need help with two basic activities like dressing or bathing, or if you have cognitive impairment like Alzheimer's. From there, you're covered for care at home, in assisted living, in memory care, or in a nursing home. You can add inflation protection so your benefits grow to help keep up with rising care costs. And your annual premium, it's locked in. It never goes up. And because this is a hybrid policy, the policy is combined with life insurance. You can get paid in 3 different ways. If you do need care, it pays benefits. If you quit the policy, you can get some money back. And if you never need care, your family gets money back. Either way, someone's getting a check, which brings us to refunds. If you never need care, your spouse or kids can receive the premiums you pay back, sometimes even more than what you paid, after both of you pass away. So is this insurance basically free? Not exactly. You could have earned interest on that money elsewhere. But getting your money back, sometimes with growth, is a nice perk. Now let's talk about what makes this policy special. The first big standout is that this is a joint policy. The joint policy means 2 people share one policy in the same pool of long-term care benefits. For example, you could use 3 years and your spouse could use 5 years. Most importantly, it gives you more combinations to use your benefits. Let's say you need 7 years of care and your spouse needs none. If you had 2 individual policies, you need 7 years, but your policy only pays 4. With this joint policy, you'd have access to that 7 years. Who knows what the future will bring, and that's why flexibility in a policy is key. Another standout is cash indemnity. Many long-term care policies use reimbursement. You submit receipts and get paid back for care expenses. CareMatters Together uses cash indemnity. Once you qualify for benefits, you can receive the full monthly benefit, even if your care costs less. For example, if your monthly benefit is $5,000, but your care only costs $2,000, a reimbursement policy will just pay that $2,000 and save the rest for later. Cash indemnity pays the full $5,000. You don't have to submit receipts, it's less paperwork, and because it's cash, it's more flexible. You can pay family members or caregivers outside an agency, or save unused benefits for later. CareMatters Together may offer more tax savings. With many long-term care policies, there can be tax advantages. But with hybrid policies, only the long-term care portion of the premium is the part that may qualify. Nationwide separates these premiums, which can make the long-term care portion easier to identify. And because this joint policy allocates more premium to the long-term care benefit, it may create more tax savings, especially for business owners. Finally, this policy has a generous elimination period. Like most policies, once you need care, there's a 90-day wait before your benefits kick in. But with this policy, on day 91, you're paid retroactively for the first 90 days. Now let's talk about the trade-offs, because every policy has them. First, that shared pool cuts both ways. If one person uses the entire benefit pool, there's nothing left for the other person. The refund or death benefit isn't paid until both policyholders pass away. And this policy sorts applicants into preferred and standard health categories. Both applicants need to be in pretty good health to get their preferred pricing. So here's my big picture opinion. This policy is often a great fit for 2 healthy people who want strong, flexible coverage for a typical long-term care event. Like Kirk and Spock, the strength of this policy is what 2 people can do together. But if your goal is very long duration coverage for both people, you should compare other options. At Long-Term What, we sell policies from all the top insurers, and we can help you find the one that's the best fit for you. I'm Jesse, and this is Long-Term What? If this helped, share it with someone who needs it, like it so more people see it, and subscribe for more unboring long-term care tips. To request quotes or to learn more, visit longtermwhat.com or see the links in the description. Thanks.